All right, soft earnings plus a weak jobs report equals an absolute wipeout in futures. 30 minutes until the start of the cash trade. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, a sea of red. The global sell-off in stocks intensifies as a weak jobs report really adds fuel to that fire. Also, big tech troubles mount. Intel, Amazon, and Apple continue the string of disappointing results this earnings season. We've got an all-star lineup of guests ahead. Acting Labor Secretary Julie Su, BlackRock's Rick Rieder, and Bank of America's Savita Subramanian join us this hour. Let's take a check at where markets are trading right now, because it is not pretty. As you can see on the screen behind me, S&P 500 futures down 1.5% pre-market. Even worse if you take a look at big tech. The Nasdaq 100 currently off by about 2.2%. And the bond market, all the action is in the bond market once again today. You can see the 10-year yield currently down 12 basis points, Sonali. We are well below that 4% level.
We certainly are. And let's take a look here really quickly at some of these big tech stocks, of course, reporting earnings. We're watching big tech, Amazon, Intel plunging. Amazon now down almost 10%. Intel another 24%. Apple getting a drop lower by 1.4% despite getting a boost from its AI features. You have a worry here about that growth scare, but also about that CapEx spending. Let's look also at the big oil earnings really quickly here at the stocks pre-market. We have Chevron falling 1.8%, Exxon falling 0.6%. Remember, Chevron missed estimates and is announcing moving its headquarters to Houston. Exxon surpassed expectations, but being caught off in this market sell-off, Katie.
Yeah, it seems like everything is getting just thrown out with the bathwater today, and you've been so good on this, Sonali. The 2-year Treasury yield, just incredible moves. You take a look at that rate, currently down by 20 basis points. That, of course, comes after this morning's jobs data, coming in with a major miss to the downside. Let's break it down with Mckee. He is Bloomberg's chief international economics and policy correspondent. So we had a Fed meeting 2 days ago. Do you think that Jerome Powell is just wishing that he had cut rates now?
Well, we knew there'd be a risk element to this week because the jobs report was 2 days after their meeting, and it does look like risk went the wrong way for the Fed. And whether or not they think this is a terrible report, it does suggest that maybe they want to reconsider policy going forward. At least that'll be the debate on Wall Street. You can see the numbers, 114,000. The forecast was for 175. We had the last 2 months were kind of revised down, not much. But it's the unemployment rate that catches everybody's eye. It works out 4.3%.
All right, Mckee, thank you. We welcome now our Bloomberg TV and radio audiences, because joining us now, I am thrilled to say we have Acting Labor Secretary Julie Su, along with our own Annmarie Hordern. And it's great to have you with us. Obviously, a big reaction to this jobs report. So we had a 114,000 increase in payrolls. You actually spoke to us back in June and said that we were looking at the definition of a soft landing. As you parse through these numbers, would you still say that today?
Hi, thank you. It's so good to be here. I mean, we, look at the 3-month average. The 3-month average in growth is still 170,000 jobs. Remember, we spent a year talking about how the numbers were too high and too hot, and we had always planned for a transition to a more sustainable, steady level of growth. This number did come in below expectations. It's still over 100,000 jobs. It's still broad-based. We saw growth in multiple industries. We saw it in construction. We saw it in healthcare. We saw it in leisure and hospitality. There was a dramatic drop in one industry, information. But generally, this is an indicator of continued strength in the economy. And when you look at other things, including labor force participation, which is at an all-time high for prime age workers, and we continue, know that there's continued work left to do to make sure that we maintain a strong economy. But we're still at a 3-month average of above the number that President Biden said a year ago we need to be to have a sustainable, strong labor market in a strong economy.
The unemployment rate came in at 4.3%, and Claudia Sahm has already said that this has now triggered the Sahm rule, which basically means we potentially are on the cusp of a recession. How concerned are you in the White House about that?
Well, we're not concerned about that specifically, in part because the unemployment rate that it grew from has been so historically low and has been so historically low for such a long time. I believe even Claudia Sahm herself expressed some questions about whether the rule applies when you start at 4% or just above 4% unemployment rate. So again, we have to keep in mind, these numbers come in not in a vacuum, but as part of a overall picture of an economy that we've been talking about for some time that did not happen by accident, that was not inevitable, in which there's been tremendous growth and an economic recovery that is frankly the envy of the world. And so we know that the work is not finished. We know that you don't get we don't stop doing the work that we've been doing. But one example of the effectiveness of the president's economic policies is that some of the growth is being driven by private investment into areas in which the president's Investing in America agenda has brought in public investments. And so those investments continue to hit the street. We'll continue to keep delivering them in different communities, and we'll continue to watch the numbers.
And of course, we're continuing to watch the numbers. We're also watching the stock market reaction right now because we're seeing a big wipeout in futures. And the conversation that's happening among investors, among market participants, is this concern that the Federal Reserve is behind the curve, that they waited too long to cut interest rates. Is that the view of the White House as well?
I mean, we don't comment on Fed policy. I know they have, they've indicated plans and what they are likely to do. We still believe that this is an economy that, again, did not recover by accident, but also is one that reflects, the Biden-Harris commitment to working people. The real wages remain up. Over the year, they're still higher than the rate of inflation. This, as I've said over and over again, means more money in the pockets of working people. And some of the story that's not part of the labor market data is that we continue to see more workers join unions, more workers reach first union contracts, more contracts result in record wage increases. Those are all further indicators of what we believe is essential to a strong economy, which is that working people do well, working people share in the profits that they help create, and working people get a voice at the table.
We had Governor J.B. Pritzker, though, yesterday talking about the loss of manufacturing jobs in Illinois, calling on the Federal Reserve to move. If the White House is not going to take a stance, I imagine more Democratic leaders are going to come out and also say that this partially may blame the Fed because it is an election year and they don't want themselves to be blamed. How concerned are you that Fed potentially acted in a way that means that more Americans would be losing their job?
I mean, manufacturing is a good example, right, of something President Biden has said from the very beginning, that we need to bring manufacturing jobs back to the United States. We need to make sure that the iconic industries like the auto industry that have powered this country's middle class continue to do so. Illinois is a place where, due to the UAW's historic contract, the president and I traveled to Belvedere, Illinois, talking about factories that are going to open that have been closed for a really long time. These reversals of decades-long trends that were not good for workers, that were not good for unions due to failed policy of the past cannot be reversed overnight, but we are seeing movement. And so that progress.
But Julie, many industries barely grew. Manufacturing, retail, information, all negative over the last 2 months.
If you look at manufacturing, since President Biden came into office, those numbers are up, and there's continued investments that we are making. If you look at construction jobs, those are also up. Those are two areas in which, again, federal investments are helping to drive that change, helping to drive that growth. And so we don't make too much of any 1 month, but when you look at the trend, those are both sectors that are up. Doesn't mean we don't have more work to do. Doesn't mean there aren't communities that remain devastated from failed economic policies of the past, that have failed working people, that have left working people behind. We remain committed to doing that work, and the overall numbers still demonstrate growth there, and we'll continue to put dollars into communities to rebuild them and bring jobs back.
And parsing through these numbers, it did seem that manufacturing payrolls did add 1,000 jobs last month. But to Anne-Marie's point, that comes after 2 straight months of declines. I want to talk about revisions here, because on the top headline number, there was another revision to last month's number. And we've seen that increasingly over the past several months, that the prior month's numbers are revised down. And I'm curious what your thoughts are as to why that dynamic is unfolding. Because, again, the question among investors is, how do I trust these numbers?
Well, you noted at the top that this month's revisions were fairly minor. Revisions, I always say this too, are a feature of the numbers, not a bug. It's not an error. It's basically continuously these numbers get revised because it's the trade-off between getting out numbers quickly and getting complete numbers. So to get the numbers out every single month, as we do, it requires a certain amount of projection. And then once the real data comes in, because these are these aren't just numbers, these are actual people, right? They're people who respond to surveys. They're people who answer questions. They don't always answer them at the time that I come here to talk about it, and that's why we revise when we get the more accurate numbers. That has always been the case, and that is why the BLS data is the gold standard when it comes to labor market information.
If we have 4.3% today, where do you see the unemployment rate year end?
Well, I'm not going to make a prediction about that, but I will say, again, we look at everything in the context of the whole. And so GDP remains very strong. Layoffs remain relatively low. The labor force participation rate remains high. All of these are counter indicators. They're not indicators of recession. And so, of course, we keep an eye out. Of course, we have to keep on doing the work that we are doing. And you know, we do want the economy to reach a state in which there's more steady, stable growth. And the, you know, 114,000 a month, you know, there were, in the last administration, 7 months of numbers that were less than 100,000. And so, again, we're in a transition period. We've always said there would be. That was part of the plan. This number is cooler than expected, and so we have continued work that we need to do. And the investments in the President's Investing in America agenda are going to be really key to continue to power our strong economy.
Well, we have to leave it there. Really appreciate your time on this busy morning. Our thanks, of course, to Acting Labor Secretary Julie Su and, of course, Bloomberg's Annmarie Hordern. And later today, catch our exclusive interview with Chicago Fed President Austin Goolsbee. That's at 12 p.m. Eastern. But don't go anywhere, because right now, Rick Rieder, he is the Global Fixed Income CIO at BlackRock. He joins us now. And Rick, my first question to you, has the Fed made a policy mistake?
So I think the price for interest rates is wrong today. I mean, you know, should they have moved? I don't know that they were set up to move, given what they had told the market prior to this. That being said, if you're running, inflation is running 3-month moving average of inflation is pretty darn close to 2 by almost every metric. And if you've got slack building in the labor force, which we knew prior to this, 5 3/8 is the wrong funds rate when you've got inflation running at certainly low to mid 2s. So, yeah, I think they're behind the curve, and I think this price for rates is not consistent with where the economy is today. Certainly not consistent with where inflation is today.
Rick, when you look over to September now, and if you look at market pricing too, it's starting to think so as well. Do you think that they're needing to go 50 basis points to really get caught up to where we're seeing the market headed?
So I don't know. I mean, there's data between now and then. I'm not sure today. If you ask them today, are they going to go 50? Listen, some of why you're seeing the increase in the unemployment rate is you're actually expanding the labor force. I mean, so much labor has come in to the labor force that's outpaced the amount of job creation, or quite frankly, it's getting those people integrated into the labor force. So I think the economy's still in pretty good shape. Is it slowing? Yes. Should the rate be lower? Yes. Would I do 50? I would do 50. I would have cut by June. I just think they need to get the rate to, if you got the interest rate to 4.5% quickly, that is much more consistent where the economy is and where inflation is today, and they should get there.
Well, let's talk about the reaction in the bond market, because the rally has been absolutely breathtaking. You take a look at the 10-year Treasury yield now, well below 4%. Rick, you and I spoke after the June numbers came out. We were at 4.4%. You think about where we are right now. Even with that in mind, what the Fed probably should do here, do you think that this rally has gone too far?
So what's pretty extraordinary is the markets have basically ignored what the Fed's saying. The markets have said, the Fed's behind. They're just going to have to get there. And so it's pretty remarkable how far the markets have come. I still think it makes sense to own interest rates. We talked about last time we were on. You keep owning the belly of the curve, hold this yield in the belly of the yield curve. How much the front end has moved for the Fed to fulfill that obligation? They're going to have to do 50, and they're going to have to move at every meeting subsequent to that. Listen, has the front end moved a bit too far? Maybe, but I'd still own the belly of the yield curve, and quite frankly, I'd still own yielding assets and hold them for 2024 and probably into the next year.
And speaking of the next year, you think about the play on duration here. If you're holding the belly, how do you feel, Rick, about the longer end of the curve, given that growth scare is the pervasive word of the day, and there's a lot of concerns about what an election could mean, what the fiscal situation of the United States could mean, and what Treasury issuance looking like into next year could mean?
I feel less good about it than I do the belly of the yield curve. I mean, the belly yield curve is the fulcrum point of where the Fed's got to go. Listen, the Treasury, like you said, it's got to issue an awful lot of debt. If you're a pension fund, you're an insurance company, you have liabilities trying to defease a liability stream. Would you match it longer out the yield curve? I guess so. But if you're not, I mean, the belly yield curve is where you want to be. I mean, I think the curve will steepen. Obviously, we've seen a significant steepening from here. I think it'll take some time. You see the demand in some of these corporate deals. You see the lack when you take out the Fed's balance sheet, the lack of available supply in the back end. It keeps the curve flatter than it should be. But will it steepen? I think it will continue to steepen. I just think it will take some time.
All right, Rick, we are just getting started. Stick with us. We're going to take another quick check on futures right now because it's ugly. You take a look at where we're trading with about 15 minutes to go. 1.3% lower on the S&P 500, 2% lower on the NASDAQ 100 in the pre-market. Small caps just taking a beating here, down 3.3% pre-market. You take a look at some of the individual moves. That's actually shocking to look at in some cases. You take a look at Intel, down 24%, close to 25% after that disappointing earnings report last night. Amazon also down about 9% pre-market with big plans to spend, and Nvidia continuing its sell-off, currently down about 4% pre-market. This is Bloomberg.
And now to high interest, a look at what's making headlines around the world. President Biden told Israel's Prime Minister Benjamin Netanyahu to agree to a ceasefire with Hamas on Thursday. The relationship between the two has been strained by the conflict as the White House's frustrations have grown over the continuation of the war in Gaza. And Vice President Harris raised a record $311 million in July, doubling Republican nominee Donald Trump's haul last month. The campaign for the presumptive Democratic nominee begins in August with $377 million in cash on hand, giving her the biggest war chest at this point in an election cycle. And Pennsylvania Governor Josh Shapiro has the edge in the race to be vice president, Kamala Harris's running mate in the upcoming presidential election. The 51-year-old has displayed agility and appeal. He could help to deliver a key state in the race and has consistently won his governorship with increasing vote shares, Katie.
And we're back now with Rick Rieder. He is Global Fixed Income CIO over at BlackRock. And Rick, I'm an ETF person. You increasingly are too. You manage the BlackRock Flexible Income ETF, ticker BINC. What's interesting to me is that you've held this consistent 40% allocation to high yield. And if we're in a situation where the Fed should maybe cut interest rates by 50 basis points in September, are you thinking about adjusting that allocation?
Not really. I mean, quite frankly, I think I said last time we were talking, high yield is not junk anymore. High yield market's in pretty good shape from a credit perspective. They term their debt out. So I still like owning high yield. What I like doing is owning it in yield, i.e., historically, you think about spread. A lot of people think about what the spread of high yield is. I mean, these yields are super attractive. Part of what I'm pretty comfortable with today, or very comfortable with today, rates are coming down. They should come down. And then if you just hold this yield, I think people a year from now are going to say, gosh, I got to buy high yield. I got to buy, like you were saying, I think we're creating almost 7% yield by buying some high yield, buying some investment grade credit, agency mortgages, creating some balanced AAA CLOs. gosh, those yields are pretty darn attractive. In a world where the equity market's clearly more uncertain, gosh, clipping that sort of yield still feels pretty good to me.
Well, you are seeing finally a little bit of spread widening. They have been super, super tight. Rick, when you see spreads start to widen, where do you start to pick up more at this point? Do you have more of an inclination to even dive in, given that people do expect a rate cut at this juncture?
So, I mean, I like owning the assets. I think the comment, we own them. We like high yield. We definitely buy more. We'd like to see, quite frankly, the price come down. What's happened is obviously rates, treasuries just rally. The market moves up a bit, doesn't move up that much. So spreads optically widen out or actually widen out. I'd like to just see the price come under a bit of pressure, a la what's happened to the equity market, and then we would definitely add some more. I mean, I'm very comfortable. The technicals, people don't realize. You talk about total supply we get in Europe. I think we get 8 to 10 billion a month in European high yield. U.S. you get 20 to 25 billion. We're getting 400 billion a week of Treasury bills. We get 100 billion on average of coupon supply in Treasuries. There's just not that many bonds in the high yield market. Right. So I'm hoping they come under some pressure.
So Rick, you're waiting for those bonds, of course, to go on sale. What's going to cause that? If we haven't seen that sell-off start already, like we're seeing in the equity market, as you pointed out, what's going to be the catalyst?
The only thing, I think most people feel like U.S. economy, while clearly slowing, while clearly moderating, it's still in pretty good shape. If you felt like we were going into recession or deeper recession, then would you start to say, gosh, I'm going to manage a bit more of my credit risk? I think so. But I still think we're pretty far from that. If you take consumer slowing, we see that the labor market is slowing. You still have tremendous amounts of CapEx, R&D spend. Like we said, we're expanding the labor force. Part of why this unemployment rate is going up, you're expanding the labor force. That actually helps instigate better levels of nominal GDP. So if you felt like we were going into deep recession, which I'm certainly not seeing in terms of the data, then you would start to bring it down. But I think we're far from that.
Rick, I want to go back to the Treasury market here, because in addition to the moves that you've seen in the spot market, the swaps market also looks pretty drastic. Pull-up function WIRP on the terminal, and you now have traders really pricing in more than 4 rate cuts this year, including more and more of a possibility here of that 50 basis point cut in September. Goodness knows if we get there. Do you think 4 is even possible, let alone reasonable, or what would amount to 4 given where pricing is expected to be at the end of this year?
So I think it's somewhat ironic. If you ask me, I'd say yes. If you ask the members of the Fed, given what they are articulating publicly, I would think they would tell you no, or at least that's not their predisposition today. But yes, I think so. Like I said, I think you've got to get the funds rate down to 4.5, and I think you should get it there. It's the wrong price today. So is it a possibility? Yes, it's a possibility. Listen, I think the Fed would still like to be deliberate. I still think they would like to see more time, more confidence. But would I do it? Yes, I think, and I think the markets are clearly suggesting to the Fed that it's time to go and it's time to move that rate down faster and more profound.
Square the square here for me, Rick, because if you believe that rates are still too high, what else breaks in this market as we wait for that first cut, even second and third cut?
So I'll tell you what's breaking. I mean, you see it play out today. I mean, the reason why the rate is clearly wrong is you look at the retailing data, the travel data, lower income is getting hurt by these rates. You look at credit card charge-offs, you look at loan delinquency, auto loan delinquencies, is a very consistent message across retailers, across travel, across auto. It's very clear that lower income, if you are a borrower, this rate is quite restrictive. What's happening in an economy today that's not that in aggregate that reliant on interest rates, but a big part of the population is, and that's what you're seeing. I know breaking, but you're seeing some pressure there, and which I would argue is too intense relative to where the economy is and clearly where inflation is.
Rick, we have 30 seconds left with you. Let's talk quickly about cash, because a lot of people are still happy to sit in cash right now. Is that trade over, though, as you think about what the next month or so could bring?
I mean, I still think cash deserves a seat at the table. I mean, when you got markets this volatile and you're still getting, because of the amount the Treasury has to issue, because of where the funds rate is still too high, cash deserves a seat at the table. I think that seat at the table should be pulled a bit further from the table, if that's the right analogy. I think listen, would I lock in these yields and get a bit longer on the curve? We talk about the belly. I would. And you start to see that certainly over the last month. You're seeing flows come in and people start to move out. But yeah, I'd still own cash. it dulls beta that you see in some of the equity market, but lower than before.
Rick, we got to leave it there. Perfect day to have you. Of course, stunning moves in the bond market. That is Rick Rieder of BlackRock. Stick with us. This is Bloomberg Open Interest.
We are moments away from looking like it's going to be a brutal start to the trading day. This is Bloomberg Open Interest. I'm Katie Greifeld. Not quite a happy Friday, of course, in futures right now after a string of weaker than expected tech earnings. Then you think about the jobs report that we got at 8:30 a.m. and then you fast forward to an hour to the ringing of those bells, of course, at the NASDAQ, at the NYSE, and there is just red on the screen in the futures market. Going to be a really ugly end to the week if this holds. So let's take a check now on the major averages, because you have the S&P 500 currently off by about 1.4%, but big tech is really where you're seeing a lot of that pain. The NASDAQ 100 currently off by about 2% or so, but all of that selling, the real brunt of the action right now is in the small caps. Your smaller companies in the Russell 2000 currently off by about 3.3%. But let's get back to earnings and two stocks to watch in the oil market. Chevron missing estimates and announcing it's moving its headquarters to Houston. Meanwhile, Exxon surpassing expectations after the acquisition of Pioneer. You're not necessarily seeing that in the share prices, Sonali.
Taking a look at the big tech names, also reporting Apple finally getting a breather, up actually at the open about 0.6%, roughly. Amazon still dropping more than 9%. Listen, Intel dropping 25%. Katie, you're looking at the worst drop in more than 2 decades for Intel. We're going to cover these names and now a little more with Bloomberg Technology co-host Ed Ludlow here in studio with us. What's going on?
Yeah, I think you start with Amazon and say it's a continuation of the same story. Capital expenditures. The number's more than $30 billion for 1H, and it will be greater than that in 2H. And the response from investors, stock down 9.5%, is simple. They still don't see the translation to direct top-line growth, specifically from selling stuff that is AI. AWS top-line growth 19%, exceeding expectations. That's great, but it's the money machine formula that we've been talking about all week. A lot of fun. The math ain't mathin' for some investors.
Even though with Amazon, you're seeing the bulk of the spending on AWS, right? Which, of course, is sort of the bright spot there. It's interesting to compare and contrast these reactions to what we saw from Meta, for example, because that was a stock where it seemed like investors were okay with that big capital spend.
So the point of absolute similarity is that you call it infrastructure spend or cloud. They're building data centers. It's an expensive enterprise. Meta's not a hyperscaler, but it does control its own infrastructure spend more directly. What they were able to show in Meta's case is that AI is helping the pricing on the ad side. So the core legacy bread and butter business is actually pretty good. In case you don't know, there's a social platform called Facebook, and it makes money with ads. And,
I've heard of that.
One was reminded of that this week. Yeah.
Listen, I want to point out here that the NASDAQ 100 falling 10% at the open means that it's sent to enter a correction territory here.
Yeah.
Intel today being the worst of the decliners in that NASDAQ 100.
Yeah.
Give us a little sense of how deep the pain is there. I mean, the drop you're seeing today is staggering.
This is very bad for Intel. It's very bad. And when the numbers dropped, the CFO, Dave Zinsner, phoned me, and basically the admission is that they had not, in a timely manner, adjusted to the reality of their revenues. Their core businesses are not doing enough to support what they want to do, which is move into data center. They're overexposed in the CPU market when what we just talked about is investment in GPUs. And so they have to cut headcount 15%, adjust OPEX and CAPEX, and make some very painful operating decisions to protect cash flow to change this business going forward. The turnaround plan, unfortunately, is not working right now.
And I have a great guest sitting to my left, but can I just say it's been so lovely to have you in New York this week?
It's been really good to sit here next to you. It's like Super Bowl week for me. And it happens 4 times a year, but it's been great. Yeah.
Come back to New York every time for it.
Ed Ludlow, it's great to see you. That, of course, is Bloomberg Technology co-host Ed Ludlow. And joining us now, also, I'm thrilled to say, we have Savita Subramanian. She is head of U.S. equity and quantitative strategy over at Bank of America Securities. Great to see you in person.
Great to be here.
Let's talk about tech.
Oh, goodness.
It feels like for so long, at least the last couple of years, that tech has been the safety trade. When you would see an ugly jobs report like this, you just go into the big FANG stocks. Now we have not so great earnings.
Right.
Is tech still the safety trade?
Well, look, I think parts of tech are still a safety trade. And I think what we're seeing right now is pretty classic. You're seeing software, which is more defensive, hold up better than semis, which is more cyclical. We are seeing some of the more crowded areas of the benchmark get sold off harder. And I think what's interesting in tech is that companies that are beating on sales are outperforming companies that are beating on earnings. So it's not just about margin, it's about top line. But I think the problem is we're at a point where all these, these tech companies and the Magnificent Seven and this AI theme has been kind of buy the story, and now it's show me the money. And that's where we're seeing real differentiation between companies that are doing things well. As your former guest was pointing out, some companies are actually monetizing their CapEx. They're seeing better pricing. Other companies aren't. And that's where we're seeing this differentiation.
So where are you seeing the strategy behind some of these pullbacks? You look at some of the exuberance finally popped out of the market, but is there kind of more pain still to come given what we're seeing in the economic data?
What I think is very interesting is that if you look at cyclical pockets, it's more of a tech sell-off than an actual cyclical, kind of collapse. And I would highlight that within industrials, you're seeing machinery companies, which would typically do quite poorly if it were just an economic malaise story. Those companies are actually holding up better than semis, which is unusual. So I think we're actually seeing a bit of a trade down or a sell-off in secular growth as well as cyclical tech companies. And I think that's where it gets a little bit more interesting. I like areas like industrials because I think there is this strong and longer term story about a CapEx cycle outside of just AI and chips. There's, infrastructure and grid and bridges and, the entire U.S. needs to be refurbished. But I think this tech sell-off is telling us that the secular growth story is maybe petering out. We are seeing more CapEx and less free cash flow. We're seeing, kind of the end of just this, wonderful period of cost cutting and just reaping sales benefits for tech companies.
Well, not to almost immediately go to politics, but you talk about that longer-term CapEx trend that you're seeing in the industrials. And I have to ask, if we get a new administration in November, now either way we're going to, does that potentially put that story at risk?
I don't think so. So we've done a lot of work looking at how much of this CapEx story is driven by fiscal stimulus versus just, kind of traditional spending. And I think there's an argument to be made that fiscal stimulus is not necessarily what's going to keep this going. In fact, when you look at fiscal spend as a percentage of total CapEx, it's just a tiny fraction of what companies, the overall capital spending and business investment story is that's taking place. In fact, I think it's less than a tenth of total CapEx over the next 10 years. On top of that, you've got tech companies spending on old economy CapEx, building out data centers and requires a little bit of, other stuff besides just tech CapEx. And we've got an environment where both sides of the aisle are focused on bringing IP back to the U.S. and bringing jobs to the U.S. What does that mean? Activity in the U.S. has basically doubled from 2018 to now in terms of driving and moving stuff around, and that is taxing the infrastructure, which is already super old, right? You look at our economy, our manufacturing complex.
You take the subway.
Exactly. Take the subway as a case study in old infrastructure. I think that's the story here.
I want to talk a little bit more, not about the fiscal, but the monetary as well. What would one rate cut really mean for the market? You have Michael Hartnett over at Bank of America as well. With you guys saying that the first rate cut should mean you should sell stocks. It would be a signal of a hard landing. How do you see this?
I think it's nuanced. So I think that this is a different rate cycle than prior rate cycles. I think the Fed is kind of, at a point where they're trying to normalize rather than really juice up the economy. The economy is slowing, but I don't know if we're at a point yet where we really need to worry about a hard landing. I do think that we are seeing some of that nervousness around the economy playing through right now. And that might make the first Fed rate cut less extreme. In fact, the old kind of playbook is buy on the rate cuts, and I think that might be kind of more of a story for maybe next year. But our target for the S&P is 5,400, and we're sticking with that. We didn't raise it as the market shot past it. I would stick with it today unless we see demand, consumer, all of the attributes, and business investment really fall off a cliff. So far, CapEx has been strong, and I don't think it's changing.
And just to go back to that point, buy on the rate cut, that was also supposed to be the playbook for small caps.
Yes.
And I'm almost scared to look at what the Russell 2000 is doing right now.
The Russell 2000 is a different animal than in prior cycles, and I think that's what we need to remember. The Russell 2000 used to be small, economically sensitive companies that would benefit from a growing economy. Today, it's half that, but also half a graveyard of old large cap companies that have refinancing risk.
Fallen angels.
Fallen angels, exactly. Those could do all right in a Fed rate cutting scenario because their refinancing risk is capped and mollified. But I think the idea of small caps just being this monolithic structure that's all going to do the same thing in a rate cut scenario is not necessarily the case.
Savita, stick with us. Of course, we're going to get right back to you. We're going to take a check on the markets, though, because, of course, as Katie has been talking about, we are looking at an ugly tape. We are looking at an S&P 500 down 1.3%. NASDAQ 100, 1.6% lower, really flirting with correction territory here. The Russell 2000 is just taking a beating at 3.5% lower. On the week, it's nearly 7% lower. We'll bring you more as we have it. Stick with us. This is Bloomberg. This is Bloomberg Open Interest, and you're looking live at the principal room. Coming up, an interview with Nextracker CEO Daniel Shugar at 10:30 a.m. Eastern. This is Bloomberg. This is Bloomberg Open Interest. A quick check on stocks here. Of course, we're looking at a tough tape. A lot of red on the screen here. The S&P 500 down 1.3%. NASDAQ 100 looking at correction territory, 1.7% lower on the day. Russell 2000 down 3.4%. Katie, down roughly 7% on the week.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Oppenheimer is upgrading Blue Owl Capital to outperform after the company saw its worst day in a year yesterday. The analyst sees a rare, attractive entry point for the company. Next up, Intel getting a downgrade, a number of downgrades today. HSBC cut its recommendation on the stock to reduce, while Raymond James downgraded it to a market perform. Now remember, the U.S. chip bellwether missed earnings estimates. It announced 15,000 job cuts, also suspended its dividend beginning in the fourth quarter. And finally, Wells Fargo analyst Mike Mayo downgrading Morgan Stanley to underweight, also trimming his price target. He cites caution over the bank's significant valuation premium, Sonali.
And back with us is Savita Subramanian, head of U.S. equity and quantitative strategy at Bank of America Securities. And I want to ask you how you think about a day like today. You see the tech sell-off underway. Is this a moment to let it breathe, or do you start to dive in and start to buy these dips in certain names?
I think you do buy the dip in certain names. I think this is a very stock-specific environment. So, as I mentioned, I think we're in an environment where you really need to see that monetization story for AI play out. And we're actually seeing that. Some of the tech companies that have done really well over the last few weeks have been companies that have exhibited that ability to turn investment into profitability and pricing. I think there's also a big pocket of stocks that look very interesting right now, which is dividend yield. So let's say we're in a risk-off environment, which it kind of feels like. What does well when the market's tanking? You want to be paid in total return, clip a coupon. And right now, even with the Fed cutting interest rates, I think there is a bigger demand for dividend yield. Because if you think about all the cash sitting on the sidelines making 5%, that 5% is going to drop when the Fed starts cutting. And we think they start, later this year. Where do these retirees go for real returns? I know bonds are offering a pretty high 10-year yield, but on a real basis, that's really more like 2% if you take the yield and subtract inflation. The retirees need investments they can live off of, and dividends offer real returns. They're inflation protected, and I think that's a great theme to hide in.
On the CapEx story, you've been talking a lot about it. What do you think about this investor sentiment changing here around the CapEx story for big tech? Do you agree that it should be punished the way it has been?
Well, look, I think that big tech spending, the hyperscalers, is a huge chunk of CapEx, but even outside of that, you're seeing CapEx from other areas. And, you know, I think that we're kind of setting ourselves up for an old school CapEx cycle, because where we are now, we have extra activity in the U.S. The U.S. infrastructure actually receives a C- in terms of, you know, its health. And I think that's a huge liability for all of these cities and municipalities that are trying to court people and jobs and companies to move to their locations. So I think there's almost this must-do CapEx cycle just to keep that story going. And again, that gets political support from both sides of the aisle. Both sides of the aisle want jobs growth in America. They want manufacturing in America. They want IP in America. They want tech dominance. I mean, another reason that I don't think we're going to see a lot of regulation for these tech companies outside of consumer protection is the idea that the U.S. definitely wants to keep its pole position as the tech leader. And regulating these companies to the point where they are no longer competitive with other regions, I think is a hard to argue stance.
Savita, I want to go back to just the price action, because again, just watching this sell-off materialize in the S&P 500, also in the NASDAQ 100, it looks like we're down more than 10% from all-time highs. Correction territory.
Correction.
Could we be heading to bear market territory?
I mean, okay, so far our S&P indicators are telling us it's going to be okay. But we have a set of 10 indicators that we look at. 5 of them are flashing red. Usually ahead of these full-fledged bear markets, you see 7 or more indicators go off. So we're not necessarily at the point of absolute, you know, anathema for equities. I do think that part of the reason is that when you look at high yield investment grade, healthy and really kind of unusually healthy, maybe the cycle's a little bit different in that a lot of the lending and the low quality lending activity took place outside of the traditional lenders and really took place in shadow lending, private equity, private credit. Those are the areas I worry about from a kind of a full-fledged risk-off perspective. But I think that publicly traded U.S. equities, at least, are pricing in the current environment when it comes to rates, inflation. You know, private equity, private credit, unmarked, who knows? You know, it takes a long time for these things to really reveal themselves, but that's where I see more risk.
Oh, you are playing at my heartstrings with that conversation. Savita Subramanian, we have to leave it there, but what a day to have you. Of course, that is Savita Subramanian of Bank of America Securities. And coming up, we're going to talk about JP Morgan CEO Jamie Dimon. He's calling for private sector representation in the White House in his latest op-ed. Is Jamie Dimon running for Treasury Secretary? We're going to discuss what's happening next in today's Wall Street Beat. This is Bloomberg.
This is Bloomberg Open Interest. Let's take a quick check on this stock market right now. About 20 minutes into the session, still doesn't look too good. The S&P 500 down about 1.4%, more so on the NASDAQ 100, off by about 2%. But if you think that's bad, take a look at the small caps. The Russell 2000 currently off by about 3%, Sonali.
We were off of session lows, at least for the Russell, but it's looking pretty grim over there in the NASDAQ 100, of course, in correction territory, as you had mentioned. And it's time now, switching gears, we're going to talk about the Wall Street Beat. Today, we're looking at Jamie Dimon's call for private sector representation in the White House in an op-ed in the Washington Post. He outlined a series of measures. Joining us now is Bloomberg finance reporter Katherine Doherty to talk about Jamie Dimon's call here and his motive. We'll talk about the actual specifics in a second here, but I do want to talk about the motive, because what does this all say about his mission moving forward? He has been much more intense about succession planning at JP Morgan, and realistically, he could be a Treasury Secretary at this point in either potential White House.
That's right. So the leader of the largest U.S. bank, he's not speaking like a banker. He's really sounding like a politician here, which is, I think, the tone of this piece is what struck me the most. Is he's not calling on either candidate, really, or aligning himself with either party. He's speaking about the unity of what he hopes America will be in the future. And I think he's being very strategic about how he's coming across in this message, so that if either candidate is picked, no matter what administration we see in November, he could potentially take a seat as the Treasury for either candidate.
It's pretty funny, right? He's kind of playing both sides here, but of course not endorsing either candidate. What did he have to say when it comes to actual policies, though?
So he really focused a lot on economic inequality. He points out that there's a lack of policies with mortgages. He says that's a very simple fix. You could give those who have trouble or affording a home the ability through mortgages and just tweaking the economics behind that, which is something that possibly a banker would think about. That is one solution. He's also calling on the border policies to be tougher. He's calling on the stance with immigration, having just to take a harder stance and to develop policies that aren't so wishy-washy. Those are not his words. But I think that there was a call for just better policies and planning and to be more clear going forward for either candidate.
And we should be clear also, all this Treasury Secretary speculation and talk, it's existed for a long time with Jamie Dimon. He's not the only one, by the way. Blair Efron over at Centerview is another person widely rumored to be a potential Treasury Secretary. And it's also not the first time, really, he's weighed in on public policy. He does this kind of often, doesn't it?
That's right. But this is the first time that I think he's come out with such criticism of just the lack of unity and how there's not a clear candidate that is really pulling together the nation in this way.
Bloomberg's Katherine Doherty, we thank you so much for your time here. Of course, a very highly watched letter there from Jamie Dimon in the Washington Post. Now, also part of the Wall Street Beat, want to take a quick check here on Ares Management Corp, dropping about 4% after reporting earnings this morning. Interestingly enough, the earnings beat expectations, but I did have a conversation this morning with the CEO on the impact of rate cuts. And something interesting, Katie, that he told me is that he thinks the capital markets, and I quote, will rip if you finally see those rate cuts. He says there will be a pretty significant amount of relief in markets and that transaction volumes are picking up already in anticipation of that relief.
Yeah, I think a lot of people would agree with him this morning, especially in the public markets, too. I mean, you think about what we're seeing across the board when it comes to the indexes. We're going to continue to talk about that next hour with Max Kettner. He is HSBC's chief multi-asset strategist, why he isn't terribly concerned about a slowdown. This is Bloomberg. All right, we're 30 minutes into a brutal trading day. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today. And coming up, a sea of red. The global sell-off in stocks intensifies as a weak jobs report adds fuel to the fire. And big tech troubles mount. Intel, Amazon, Apple continue the string of disappointing results this earnings season. Apple really wavering this morning, though. We'll keep an eye on all of it for you. An earnings miss for Chevron as the oil giant quits California for Texas. An interview with the CEO just a moment away. Katie.
And let's get a check on these markets right now. As I mentioned, not too pretty. The S&P 500 off by about 1.6%. That NASDAQ 100 sell-off picking up a little bit of steam here, currently down about 2.4%. We're going to end up with a pretty ugly weekly drop there. And then you take a look at the bond market. At least you have your bonds acting as a haven this morning. The 10-year yield currently lower by about 13 basis points. We are well below 4%.
And of course, we have an even starker move in that a 2-year yield. Also, just wanted to point out durable goods orders also out. Orders falling 6.7% month over month. The estimate had been for 6%, so a little more than expected. And June factory orders also falling 3.3% month over month. The estimate was 3.2%. More signs of weakness in this economy. And acting U.S. Labor Secretary Julie Su joined us last hour on the jobs data. Take a listen.
We continue, know that there's continued work left to do to make sure that we maintain a strong economy. But we're still at a 3-month average of above the number that President Biden said a year ago we need to be to have a sustainable, strong labor market in a strong economy.
Let's get some thoughts now on the week payrolls number with Max Kettner, HSBC Chief Multi-Asset Strategist. You know, Max, the last time we spoke, I think it was on a green day, and you're looking at today, and the sell-off is pretty swift at what you're looking at here. Have your thoughts changed at all about the direction of travel given the latest data we've seen and the market sentiment, the repositioning you're seeing among traders, or do you buy the dip?
Yeah, I don't think our fundamental view has changed an awful lot, actually. A lot of it, I think, is positioning driven. When we look at CTA positioning, for example, in equities, that was as long equities as it's last been during that meme craziness in summer 2021. So there's a bit of positioning clearing. We are, of course, seeing most of the setback is driven by tech, right? So it's not really driven by the most cyclical names and getting beaten up. No, it's mostly really a tech-driven sell-off. It's mostly that repositioning, that sort of overhang that we had from systematic investors. And honestly, when we look at the fundamentals, even at the payrolls today, I get it. Yes, they've been weaker than expected, but it's not like we've lost 100,000 jobs. In fact, when we look at something like Challenger job cards, they're still almost as low as the absolute lows from the 2010s, which I think were sort of December 2015. When we look at the layoffs, the number of layoffs, they're still lower than the absolute lows from the 2010s. So what we're not seeing is that the unemployment rate is going up because really companies are shedding jobs everywhere. I get it that, you know, the job cuts from the likes of Intel, they're grabbing the headlines, but on aggregate, we're not seeing those broad-based layoffs yet. And that doesn't, for me, change the fundamental bullish picture.
So, Max, you think about the phrase of the day, growth scare. It sounds like you're not quite buying into that.
No, absolutely not. I don't buy into it. I do think that actually the 50 basis points rate cuts in September, that is now being touted, that is really a bit overblown, that those fears or even fears of an intra-meeting cut that really aren't justified. You know, think about Q2 GDP growth. We saw an almost 6% nominal GDP growth. I don't know if that qualifies as recession. I don't know. I might have skipped my lectures at uni too much then. But when we look at the earnings season, at the Q2 reporting season, we're talking about a 14% earnings growth year over year. We're talking about that it's more broadening out. We're seeing, you know, an almost 80% beat rate. We're looking at sort of surprise factors on the earnings side of more than 4.5%, which is bang in line with average. So, you know, on aggregate, things are still pretty fine, right? They are decelerating in some pockets. There are some cracks in some pockets, absolutely fine. But that doesn't automatically equate to a recession is coming.
So what is the trading strategy at this point in time? To the point that you're making here, it's pretty interesting. If you look at the S&P 500 today, you do have most sectors here in the red, but you do have a little green on the screen. And in some areas of the consumer, you still see some green in real estate. So interest rate sensitive sectors, if you get a relief, then perhaps you can see a tear in some of the more badly beaten sectors. Is there still a rotation to be had, even if that rotation may not be the same type of rotation that we've seen maybe even just a week ago?
Yeah, I don't think that rotation from a week ago still makes sense. I really don't think that sort of Russell 2000 or US small cap rotation made an awful lot of sense, because if indeed growth is slowing and you're buying small caps just because of the notion of lower yields, then that's really just on borrowed time. So I don't think that rotation into the Russell, where it was really, you know, let's remember in the Russell, there's almost 40% of the companies that which the debt is on a floating rate, so slightly higher yields, pricing out 50 basis points of rate cuts in September would really hurt them. And we know that almost 40% of the companies don't make profits. So that rotation doesn't make sense. In fact, I still am pretty positive, and we continue to be pretty positive on the tech sector. Whereas, you know, three weeks ago, it was all about AI and everything was great. Now it's all about, well, you know, are they really making money out of it and all this sort of stuff? Well, in fact, you know, yeah, that correction, what we've seen right now, that positioning overhang that is now being cleared, that's probably more of a healthy correction. And you probably want to more lean into that rather than really throw in the towel there.
All right, so there you go. Some pushback against that story that we've been hearing again, people really shying away from that big spending going on at the tech names. I do want to point out the VIX. I was kind of ragging on it earlier in the week, but it has skyrocketed over the past few sessions, currently trading at 22. That is the highest level in at least a year, Max. I hear what you're saying about positioning, clearing out. The fundamental story is still there, but you think about the volatility being injected back into this market. How do you handle it over at HSBC?
Well, in fact, it means that we're very close to buying opportunities. It really means that we're much closer to the end of the dip rather than the beginning of it. What we've done was a study a couple of years ago where we looked at forward returns, not only of things like EM equities or credit, but most plainly equities over rates, equities over treasuries. So when is it time to buy the dip when the VIX goes up? And usually the threshold starts to be sort of 23, 24. Once we start going over 23, 24, then really sort of 3-month forward returns of equities relative to fixed income start becoming really, really favorable. So given that we're almost now, as you've just shown, we're almost at 23 in the VIX, we're much closer to buying territory now rather than throwing in the towel.
All right, Max, really great to speak with you. A real different perspective here from what we've been hearing this morning. So appreciate you making the time for us on this Friday. That, of course, is Max Kettner of HSBC. Of course, we have much more on the FOMC throughout the day. At noon, we'll be speaking exclusively to Chicago Fed President Austin Goolsbee. Meanwhile, let's take a check of these markets, take stock of what's happening. The S&P 500 now down by more than 2%. The NASDAQ 100 accelerating as well. That sell-off underway, nearing in on a 3% drawdown for the day. All the while, you actually have the bond market rallying, providing a little bit of that haven buffer. 10-year yields currently down by 15 to 16 basis points. Meanwhile, let's take a quick check of some of the stocks really driving the action today. Good news on Apple. It's up 1.6%. So we do have some green there, but that's, of course, outweighed by what we're seeing in Amazon, with shares down 12%. Even though you have the Max Kettner view, investors broadly spooked by just how much money they're spending. Then Intel, of course, down nearly 30%. Now, coming up, Chevron earnings disappoint, and the company announces plans to move its headquarters from California to Texas. We'll hear from the CEO next. This is Bloomberg.
I want to take a quick look here at the 2-year yield because, of course, you started the week at normally around 4.4%. You're down now to 3.9%. There was a 21 basis point drop off today, and you saw that hold really after that jobs print this morning. Just a stunning move in the bond market and a recalibration of expectations heading into the September Fed meeting. Now to high interest, a look at what's making headlines around the world. On front pages around the world is the news that Evan Gershkovich arrived home in the United States yesterday to a hero's welcome. The Wall Street Journal reporter and 15 others were released by Russia in exchange for 8 Russian prisoners. The president and the vice president greeted them after the largest prisoner swap between the East and the West since the Cold War. And JP Morgan CEO Jamie Dimon said the next U.S. president must work to bring together a deeply divided nation as issues mount at home and abroad. The banking boss also said that the business world should have representation in the cabinet in an opinion piece published today in the Washington Post. And President Biden told Israel's Prime Minister Benjamin Netanyahu to agree to a ceasefire with Hamas on Thursday. The relationship between the two has been strained by the conflict as the White House's frustrations have grown over the continuation of the war in Gaza. Katie.
Meanwhile, in the energy sector, Chevron missing profit estimates despite record production in the Permian Basin. The company also announcing plans to move its headquarters from California to Texas. Now, the disappointing quarter adding pressure to the company's $53 billion effort to acquire Hess. Bloomberg's Alix Steele caught up with Chevron CEO Mike Wirth.
We had some higher maintenance. We had a couple of events at LNG facilities that required maintenance during the quarter, which brought liftings down. And so it's a little bit hard, I think, for analysts to anticipate that. We tried to communicate those events, but we had that. Refining margins came off hard in some of our key markets. And then there were some one-time items, well write-offs and tax items that are very difficult to forecast. So these are non-recurring items that made the quarter a little bit light versus expectations, but the underlying execution is good. And as I said, the growth remains strong.
So now you, though, have to wait till May 2025 for the arbitration to work out when it comes to that Hess deal. Why is this taking so long? Like, if it's a simple issue or it's an issue of scheduling, what's the problem?
Well, international arbitration often is a lengthy process. Selecting the arbitrators, getting schedules aligned between all the parties and the arbitrators is more complex sometimes than one might expect. We do continue to see this as a straightforward contract interpretation question, and we continue to remain confident that the arbitration will affirm Hess and Chevron's interpretation of it. But you're correct; it is taking more time than we had originally anticipated, and that's unfortunately not unusual when you get into international arbitration.
Moving to some of the intricacies of the quarter, you mentioned it, that record production for Chevron in the Permian, which kind of leads me to you guys moving your headquarters to Texas. Is part of that needing to be closer to sort of the core business of operations right now?
Well, it's really to be closer to the core, epicenter of our industry. Houston is the energy capital of the world. We have key partners that are there, suppliers, vendors, the universities that we do a lot of research with and recruiting from are there. And so it's a natural place for companies in our industry to have their home office and headquarters. And in fact, over the last many years, we've seen our Houston-based employee population go up and our California-based employee population come down. And this is really concluding a process that has been underway. We know how to work around the world in kind of a virtual environment, but there's no substitute for being face-to-face with people in terms of collaboration, innovation, mentoring and development, external relations and engagement. And Houston really is the place for our company to be for all of those reasons. We do have a big business footprint in Texas, which is now larger than our business footprint in California. For many, many years, that was not the case. California was our home, it was our birthplace, and it was where our largest business footprint is. And so that's certainly a change that has occurred, but the primary motivator here is to get our people together to increase engagement and collaboration.
So pro-Texas versus anti-California?
I wouldn't necessarily put it that way. I would look, we've had some policy differences with California, and certainly California and Texas approach energy very differently. And so we speak up on that. We advocate for policies that keep prices low, that keep supply reliable, that encourage investment. And California's advanced policies that do the opposite. And so we've certainly expressed our views that we don't think that's good for the California economy. But this isn't a move about politics. It's a move about what's good for our company to compete and perform.
And I'm pleased to say that Alix Steele joins us now. Great interview, of course. And I have to say, I didn't know that Chevron was headquartered in California. It seems like Texas would be the natural home here.
It does. But remember, the Permian wasn't always the Permian. The Permian was just some rock that no one drilled. So now that that's become so important, whether through Exxon and the Pioneer acquisition or through Noble and a PDC acquisition for Chevron, it does make sense from that aspect. Also, now the U.S. is a huge exporter of energy, right? So it also kind of makes sense for you to be headquartered in the Gulf Coast, which is where so much is also being exported. Plus, they're starting a Gulf of Mexico asset, so that's really big for them now as well. So from that perspective, it'll be a slow, few years until this happens, but that's part of it.
So not necessarily politics that's driving them there.
I mean,
maybe a little bit of everything.
Yes, no. I mean, I don't think politics helps any either at the end of the day.
I want to talk a little bit about the pressure here that Chevron is under when it comes to Hess. This is a massive $53 billion deal, a lot of delays. How did they really respond to that uncertainty?
I mean, the problem is it keeps getting pushed out, and that's really the problem. That it went into FTC review, yeah, sure. The arbitration was definitely a surprise, but that it keeps getting pushed out and the lack of visibility is actually quite difficult. And the problem is it just highlights what Exxon has and what Chevron doesn't. And if you're an oil investor, can you really own both of those stocks in your portfolio? If you can, great. If you can't, do you go with the one that has Guyana, or you go with the one that might not have Guyana until May of 2025? And that just kind of delays and pushes it out. Now, Mike Wirth is going to say, but we have a really strong production profile in the Permian. We have really strong overseas assets. We have Gulf of Mexico, their Tengiz operation in Kazakhstan. huge cost overruns, but he's going to talk pretty positively about that production profile. But you know what? It's still not Guyana, and that's really where the growth profile is going to be coming from.
Well, this gets to what you were saying in the commercial break, right, Sonali? Like, is this a pair trade that's developing? How are investors thinking about this?
I mean, I don't want to say yes, but I don't want to say no to that. I mean, I don't know if
You're doing a very good economist.
Yeah, thank you. I don't know if it's easy to be like short Chevron, like buy Exxon. I don't think it's that clear in any way whatsoever, because, you know, Chevron isn't just maybe Guyana. Like, they do have a behemoth assets in the Permian. They have great stuff going on there as well. But that is a tough asset to then live without. They're going to say they can live without it, but still.
Can you explain a little bit more behind the stock move today? Because ultimately it wasn't just about Hess.
It wasn't just about Hess. So it was about a couple things, largely about Hess. But also they had a huge earnings miss, and a large part of that is due to some international earnings revenue miss. And you heard Mike Wirth talking about that on the tape, that some of it was like a one-off. He doesn't necessarily expect that to continue. That's one-off, tax things, like the stuff you wouldn't have had clarity on before. But what we do know is that Tengizig in Kazakhstan has had a lot of cost overruns over the years. It's supposed to be on track, but that's always going to be a question mark. You've also had Chevron be hit really hard with the war in Israel and Gaza, because they have a natural gas deposit over there as well. And the Gorgon facility, LNG facility over in Australia, has also had a lot of difficulties. So there are just production stuff that is happening, as you do when you're an oil company. You always have production stuff that you got to maintain and take care of.
What about renewables? I know that this did come up in fits and starts, but I understand that they took a little bit of a different approach here in how they addressed the question around renewables.
So particularly when it comes to Exxon, actually. So they actually addressed this on the call, and saying the complexity of low carbon markets is particularly challenging. And they talk about how it involves new technology and new markets and not an existing customer base. That is very different than the European guys like Shell and BP and the approach that they've taken. They invested heavily in renewables, are now pulling back a little bit and sort of not moving away from oil and gas in the same way. Chevron is somewhere like in the middle. I mean, they have their own venture profile where they can put money into new cool stuff. They have a hydrogen project they're working on. So I think that for both Chevron and Exxon, what they're doing is they're trying to stick to their knitting. Like, what can I do in the energy transition space that already is stuff that I'm doing? Like, I'm drilling stuff out of rocks, I'm putting stuff in rocks. Like, how can I keep doing that when it comes to the energy transition? And that's sort of that approach versus like, hey, let me go buy this wind farm, for example.
Alix, we thank you so very much for your time, for your reporting, for your great interview as well. That is, of course, Bloomberg's Alix Steele. Now, I want to get a check on the markets here, because you are seeing a VIX flying to a 25 handle. Remember, we started the week lower to around 16, so a very significant move over the day and over the week. We started the show at 20, Katie. I mean, just sitting here, we see the index level volatility rising.
It's like a rubber band.
It is like a rubber band, and it is interesting because you had market participants complaining for months, really, that there has been volatility, just more in the single stock name, more in the options market. Underneath the surface, you are seeing that come to light in a very significant way. Remember, over the 1 year, the average VIX was 14, so 25 is pretty hefty, and you have to wonder if that will start to stifle some of the capital markets activity that people have been so long awaiting for. I also want to flip up the board here, take a look at yields, because you now have Citigroup coming out predicting a half-point Fed rate cut in September and November. And you look at the rating removes here in the Fed swaps market, you really have the market starting to get in line with that idea at a little more of a rate. Right now, the implied rate as more than 40 basis points in September alone. We'll keep an eye on it for you, but of course, the market's moving under the surface and at the surface as well. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Hertz reporting a worse than expected loss after its bet on Tesla EVs took a wrong turn. Remember, back in 2021, the car rental company made a massive purchase of Model 3 and Model Y vehicles. But Tesla started slashing prices of those models just a year later, really demolishing the resale value. Hertz now selling its EVs at a loss. Next up, Warren Buffett's Bank of America selling spree still in full effect. Yesterday marked the 12th straight day that Berkshire Hathaway has trimmed its massive stake in the lender. Now, since mid-July, Buffett has banked $3.8 billion on that unwind. And finally, Taco Bell also shelling out a lot of dough for AI technology in its drive-thru lanes. Parent company Yum Brands announcing it will expand its voice AI technology to hundreds of locations before the end of the year. And that news comes after McDonald's pulls the plug on its own AI technology after consumers complained about the system getting their orders wrong. You can follow all the latest company buzz on TRE and Go on your Bloomberg terminal, but take a quick check of these markets right now because that is the story today. The S&P 500 currently off by about 2.3%. More so if you take a look at the NASDAQ 100 off by about 3%. And that rally in the bond market, Sonali, it just continues. The 10-year yield currently off by about 15 basis points.
We are in correction territory on that NASDAQ 100 and, of course, quickening those losses on the S&P 500. We will keep you on these markets as we go throughout the hour. But coming up next, solar giant Nextracker posts an earnings beat, a bright spot in this earnings season. We're going to speak to CEO Daniel Shugar next. Stick with us. This is Bloomberg.
Solar giant Nextracker soaking up the revenue in the first quarter, the revenue coming in over $100 million. That is above the Bloomberg consensus estimate. Now, despite that massive beat, the company still maintaining its 2025 forecast. And joining us now, I'm pleased to say we have Daniel Shugar. He is the CEO of Nextracker, which, of course, is the leading provider of intelligent solar trackers. So let's talk through the guide, because you take a look at the share reaction right now, currently down about 8%. A lot of the sell side pointing to the guide. Walk us through it.
Well, we couldn't be more pleased with our results. 50% year-on-year growth from last year. It's been our sixth quarter of double-digit growth, and that's because solar is the lowest cost way to generate power on most places on the earth. We are forecasting for this year another year of significant growth. This is our first quarter, so we exceeded plan. We're going to manage the business appropriately.
To that end, yes, it was only really months ago that you were spun out of Flex. And as a standalone company now, what are you doing differently than when you were not a standalone?
Well, we just announced two super exciting acquisitions. We acquired a company called Ojo and another company called Solar Pile International. And let me explain what they do. Nextracker makes intelligent tracking systems that help the panels be aimed at the sun. And what these two exciting companies do is help you practically mount it in difficult site conditions. For example, hard rock, where you can drill and set the foundations of these systems, or in softer soils and places like that. So now that we're a spun out, fully independent company, we're in a very strong liquidity position. What we've done is, in a diligent way, done prudent, disciplined acquisitions to really help increase the total available market and solve problems for customers.
And so with that in mind, that strong liquidity position, you mentioned the acquisitions that you've made recently. Are more potentially on the horizon?
Well, we're always open to great ideas. The main thing is driving value for customers and helping solar continue to be the lowest cost way to generate energy, breaking away from polluting industries like coal and nuclear and things like that. And so what we're really focused on is discipline and in our evaluations and making acquisitions that deliver value and that are accretive over time.
Dan, there's a lot of question about what this election cycle means for solar, for other forms of greener energy sources. And if Trump were to win the White House, what would you think the biggest change would be in energy policy, and how would that be impacting you?
Right. Well, the growth in solar is really about fantastic technological progress, innovation, and cost reduction. We grew significantly under Obama. We grew more under Trump. And we're growing more now. It's not about politics. It's about what's the lowest cost, lowest risk way to generate power. And the thing folks don't necessarily appreciate is how much power is needed both in the U.S. and abroad. Nextracker operates in 40 countries around the world, and what we're seeing is very strong load growth driven by data centers, electrification of vehicles and other demand, and in the U.S., reindustrialization. So we need power, the lowest cost, best return for investors, and safest way for us to build, which advances our energy security and energy independence, is to use renewable energy. So the other thing Nextracker has done is we've stood up 20 factories with our partners across the U.S. Across the political spectrum, most of our manufacturing facilities are in traditionally red states. And so we're generating thousands of additional jobs. Our industries announced over 150 factory openings in the last few years. So this is really about jobs, energy independence, and lowering costs for customers.
Dan, we thank you so very much for your time. Of course, that is Dan Shugar, Nextracker founder and CEO, off the heels of the company's earnings report. Let's go to check on these markets now, because that sell-off still underway. The S&P 500 just off of session lows, but still the sell-off has quickened throughout the morning. You're at 2.3% lower on the day on the S&P 500. Even worse so on the NASDAQ 100, nearly 3% down on the day into correction territory. The 10-year yield has a 14 basis point move lower. Significant moves on both long end and even much more so on the short end of the curve. The 2-year yield down about 21 basis points or so, and the VIX just soaring. And joining us now, we're going to talk more about the markets here with Kaissar, Bloomberg opinion columnist covering markets. He's also founder of Unison Advisors, an asset management firm. And you look at the moves that we're seeing today, there's pretty broad-based moves you're seeing in the market. But let's hone in here on what we see in technology, in those magnificent 7 names, now that we have much more information about what earnings look like. Is this a greater selling opportunity at bay when you see how much there has already been selling pressure on an industry that has been a haven industry for so long?
Hi, Sonali. I think it very well might be, and investors have to take that very seriously. And because this week, earnings numbers were not as glowing as they might have been, let's say. And that might be just enough of a jolt for investors, which they didn't really need if they were looking at the numbers. And the reason I say that is because for the better part of 10 years, the market in general, and the NASDAQ in particular, has lived on the earnings growth of the Mag 7, collectively have grown earnings by more than 40% a year. I mean, that's obviously long-term unsustainable, amazing in the short run, but long-term unsustainable. And then look at the earnings assumptions inside the Mag 7. Bloomberg helpfully has a Bloomberg Mag 7 index, so you can dial those numbers up. And what you'll see is that the expected earnings growth collectively for this year is roughly 17%, and for next year it's roughly 19%. That's still incredible, but it's well short, less than half of the kind of earnings growth we've seen previously over the last 10 years. And that means that we're going to have some sort of repricing. How fast that repricing happens and to what extent investors have a runway is an open question. But I think you're starting to see investors look at this and say, we just can't ignore this anymore.
It's so interesting to be having this conversation, because I remember a few months ago when we were still, of course, those halcyon days where big tech was just leading the pack and we were rallying, that the answer that I got most often was that the fundamentals justify the valuations. But it now sounds like the story that we're talking about and that you're telling right now is basically that expectations just got too high for some of these huge tech names. To your point, they're still putting up huge numbers.
Yeah, the numbers are great. There's another way. I think that's right. And there's another way to look at this is you can look at estimates further out. It's a little bit dicey because the further out you go, the more volatility there are in those estimates. In other words, there's more disagreement about what those estimates are going to be, obviously, because it's harder to tell the further you look out. But when you look at those estimates, what you see is, if you look 3 to 5 years out, let's just say, what you see is that on a PE basis, these stocks are roughly the same. But the earnings that are built into them look like the earnings of the previous decade. They don't look like the earnings that a lot of people expect over the next year or two. And so you have to ask yourself, what is the probability that they will continue to grow at these rates? And if the answer is not that high, then, obviously the multiples that we're seeing now based on those earnings are garbage. I mean, they're just not something you can rely on.
Near, I want to take a look at the Philadelphia Semiconductor Index. Katie all day has been making this great point that if the big tech companies are getting burned on CapEx, they are still spending, then you would not think that you would see this kind of pain to their suppliers. NVIDIA has Microsoft as a massive client, for example. If they're spending, that would be good for NVIDIA. Yet you see this semiconductor index fall off another 6% today, nearly 7% yesterday. It has been ugly. Most of these names are in the red. Of course, Intel, that is an absolutely spectacular drop that we are seeing today as well. What do you make of this story when it comes to chips, when it comes to semis, when it comes to the infrastructure of this AI story?
I think that's a really interesting proxy, Sonali, for what we're talking about now, because ultimately, I think the enthusiasm that's built in going forward for a lot of the Mac 7 is around the AI story. It's not necessarily around core business, although there is some of that as well, obviously. And so the question is, and there's been a lot of questions about this, to what extent is that AI story overdone? To what extent is the investment they're making going to pay off? I mean, it has to pay off in the reasonable near term. I mean, if it pays off in 20 to 30 years, that's wonderful, but that's not going to help investors at these valuations. And so one way to think about that is to look at the semiconductor space and to say, okay, what is the enthusiasm around there? Because if the AI story is real, you would think that semiconductors are going to do well. And if there are a lot of doubts about that story, then you would think that that would be the first line to get hit. And I think the fact that you're seeing some softness there tells you, and dovetails in with what we're talking about, I think it tells you that maybe the AI trade or the AI enthusiasm around future earnings is overdone. And we need to start rethinking about what reasonable earnings growth is and what then a reasonable multiple is based on that.
And NVIDIA shares down 9% this week. It is just going to be so fascinating to see them report. But we have to wait all the way until the end of August. So we'll put a pin in that. Let's talk about the Fed, because you've seen a lot of big, bold Fed calls come out for what they're going to do in September. Where are you leaning right now?
You know, Katie, I do not think I don't think a rate hike is a done deal by any stretch.
A rate cut, you mean?
I'm sorry. Thank you. A rate cut is a done deal by any stretch of the imagination. In a rate hike, wouldn't that be a surprise?
Right.
In September. And the reason I say that is because if you look at the dual mandate, on the one hand, payrolls are still growing. The unemployment rate today at 4.3% is higher than it was, but still lower than what a lot of people see as the unofficial Fed target of 5%. And in any event, it's well below what you would see during recessionary unemployment. On the other hand, you have the PCE food and energy year over year that's going down, but it still is about 2.6% year over year over at the last read. And so the Fed is not there yet. And so reasonable people can look at these two things and say, okay, which way should we go on rate cuts? But I think the Fed has already signaled to us what it's going to do, in my opinion, because if you look at what happened in 2021 when they had to raise rates, they waited about 6 months. Inflation ticked up before they even started making noise about raising rates. And then once they got there, they waited another 6 months to actually raise rates. And so they just started making noise at this last meeting about cutting rates. And my guess is they're going to be afraid of a replay of the 1970s. They're going to wait, even though I know everyone wants a rate cut because everybody wants lower rates. I would not bank on it. I think you may be a few meetings away.
Yeah, painful history lesson there. Near, always great to speak with you. Have a great weekend when you get there. Our thanks to Near Kaissar of Bloomberg Opinion. Now let's take a quick check on these markets, because the S&P 500 at session lows right now, down 2.6%. Similar story if you take a look at the NASDAQ 100, down about 3%. And meanwhile, that bond market rally building steam, 10-year yields down 16 basis points. This is Bloomberg. Well, Bloomberg's David Weston spoke with key players in economics and business this week at the Aspen Economic Strategy Group's annual meeting. David asked former Treasury Secretary Larry Summers how economic discussions have changed over the past 5 years.
Whether it's about the defense industrial base and making sure it's strong when we discuss industrial type policies, whether it's the danger that an overly indebted country won't be able to find the will to mount sufficient response, that perhaps the world's greatest debtor can't remain the world's greatest superpower, whether it is the questions of just growing our economy and maintaining our technological leadership, I think there's a kind of seriousness to the economic policy discussion that's framed as some people have put it here, that it's a 1938-like moment, or at least it might be a 1938-like moment. And that, coupled with the complexity of our internal political challenges, makes this a very, very serious moment.
And when you think about those questions, at least it occurs to me there are two categories of questions. One is, will we have enough money? Do we have the fiscal headroom to spend what we need to on defense? The other is, are we spending money the right way? I mean, you mentioned Ukraine. The experience in Ukraine suggests warfare is really changing as we see these low-cost drones, what they did, for example, to the fleet of the Russians in the Black Sea.
David, I think there are two different things that you have to say. One is, I think we need a greatly enhanced focus on implementation in everything we do in government. You know, you look at how much it costs to build a mile of highway versus how much it costs to build a mile of highway in 1955. You look at the New York City subway in the 21st century and the New York City subway in the 19th century. You look at the difficulties that the Boeing Corporation is having, whether it's with the space shuttle or whether it is with safe airplanes. You look at how much more productive in terms of putting things into space Elon Musk has been than, frankly, NASA has been. You look at the security threat our country faced a week ago from that cyber attack. I think the task of doing things effectively, as well as conceiving policy, is going to be profoundly important.
Another subject on the agenda for the Aspen Economic Strategy Group this year is higher education, which you know backwards and forwards, having been president of Harvard as well as having been a faculty member there for so many years. That I'm not sure would have been on the agenda 5 years ago. What is the state of higher education? How concerned should we be?
Look, I think any discussion has to begin with the fact that so many students from so many other parts of the world want to come to American universities, and that American universities are a magnet. They are an export industry for our country. They are a source of knowledge. There's plenty to criticize, and I will in just a moment, but our higher education system in its totality is the envy of the world. But I do think in some ways, particularly in the elite aspects, they've lost their way.
And that, of course, was former Treasury Secretary and Wall Street Week contributor Larry Summers speaking with Wall Street Week host David Weston. This is Bloomberg. Well, Dr. Doom is looking for his next patient. Economist Nouriel Roubini is looking to enter the $9.4 trillion ETF universe. And for more on this ETF Friday, we're joined now by James Seyffart. He is ETF analyst over at Bloomberg Intelligence. And James, this is just a filing. It hasn't launched yet, but feels like today would be a pretty good day for a Dr. Doom ETF.
Yeah, I mean, honestly, this ETF filing says he's going to go anywhere, but some of the things he mentions, like real estate and a few other things in the market, they're actually doing really well today. So, I mean, right now the market obviously is it's not doing well, but if you're looking at real estate ETFs and utilities ETFs, real assets, the types of things that he seems to most likely kind of be focusing on, he kind of leaves it open to go wherever he wants. But he'd probably be doing okay today as far as ETF performance goes.
So we'll see, of course, when this one gets to the finish line. This is interesting because, of course, you have Nouriel Roubini filing for an ETF this week. You also had Tom Lee filing for an ETF this week. And I think this trend is really interesting, James, that you have more of these sort of high-profile names coming into the ETF wrapper.
Yeah, I mean, I think it shows that everyone's looking at ETFs now, right? Which is something we've been talking about. I mean, you're on ETF IQ. It's something we've believed for many years, but it seems to be kind of hitting the zeitgeist, if you will. I mean, a few years ago, maybe even 5, 6, 7 years ago, these guys probably would be just launching a hedge fund. They wouldn't really be looking at the ETF space, but they've seen a bunch of different people have a lot of success. And they're going to give it a try. There's been plenty of examples of active managers. There's even people that are have a huge social media following launching ETFs that are finding some minor success. There's a lot of different people out there.
Would Bill Ackman have been better off just trying to launch an ETF rather than a closed-end fund?
Yeah, I mean, I think he should just launch an ETF. But there are some things you can do in a closed-end fund that you can't do in an ETF. You can issue debt. You can be a little more activist in the way you do things. But I think, honestly, if he couldn't raise the type of money he wanted to raise in an IPO for his closed-end fund, maybe he should just look at launching an ETF, and we'll see what type of interest he actually gets.
And it's also important to point out, in a closed-end fund, you have permanent capital. I have to imagine that is very attractive to a lot of managers, including Bill Ackman. But who knows, now that we've put that out into the universe. James Seyffart of Bloomberg Intelligence, thank you so much for your time. And, of course, tune into ETF IQ every Monday at 12 p.m. Eastern. Meanwhile, Wall Street banks, of course, revising their forecasts for rate cuts after today's weak jobs number. Let's get into some of it right now because Goldman adding a third quarter-point cut to their 2024 forecast. Citi predicting a half-point cut in September and November. Pretty dramatic there. And Bank of America now sees cuts starting in September instead of its previous call of December. So it feels like we've all coalesced around September. That had already been the case. Now you're hearing more people say the Fed should have cut this week. They should have cut rates on Wednesday.
Yeah, and it's fascinating. You're seeing that violent move right underneath the surface here in the bond market as well. We had the 2-year really drop as low as 384 on the day. We're standing at 3.9% right now, Katie.
Yeah.
So really significant move. That VIX is now at 27, a 27 handle. If you could imagine, that is more than 10 ticks higher than where we started the week. And as Mohamed El-Erian had been saying all morning, these moves, if they were alone, that's one thing. But the fact that you're seeing the bond market moves again, already extreme bond market moves this week makes it all the more exciting.
And you made a really good point earlier that there has been volatility in this market, but it's been at the single stock level. If you take a look at the average single stock volatility, it's been higher than the VIX, but now you're starting to see it break out to that broad index level volatility as well. That's something that this market has been missing. You've seen people saying that it would come back, and now it's sort of a be careful what you wish for moment.
The NASDAQ 100 is in a correction, but the VIX is certainly here to party. It is Friday after all, Katie. And you know what? We have a massive, massive, massive week ahead. Coming up next week on Open Interest, we're going to have a lot of C-suite conversations. We're going to be talking to the CEOs of Vanguard, Lucid, Robinhood, just to name a few. We're going to give you the micro to the macro, of course, all week long, and another big week of earnings, though we are through the brunt of it. Take a breather, guys. It is almost the weekend, but a long day ahead for you still.
Yeah, absolutely. Have a great weekend when you get there. This has been Bloomberg Open Interest, and this is Bloomberg.